I think that it's important to understand the facility that the Fed created. So what the Fed did this weekend is essentially create a buyer of last resort again. If you look at all of the assets that are underwater because of all the rate hikes that Sachs talked about, and you add up all those losses, that is about $2 trillion. And the Fed didn't announce that there was a beginning and an end to this program other than saying these would be one-year loans. And so I think the exposure for the American banking system at a minimum is going to be this $2 trillion.
About a week ago, following the first signs of a widespread contagion in the American and possibly global banking sector, U.S. regulators sprung into action, unveiling plans to make depositors' funds whole under the systemic risk exception approved by the Treasury Department and the Federal Reserve. In addition, the central bank created a discount window during which it will loosen its borrowing guidelines for banks seeking short-term funding. It also established a facility where banks can exchange limitless underwater securities for one-year loans. Since regulators unveiled these temporary bailout plans on Sunday evening, several top investors and analysts have detailed how the Fed's actions could worsen the economic situation in the short and long term. Many believe the bailout removes the incentive for banks to be more responsible with deposits and customers' funds in general. During a recent episode of the All In podcast, Canadian-American venture capitalist Chamath shared his thoughts on the Fed's emergency and unlimited bailout plans for the banking sector. Chamath noted that outside the top banks in the U.S., there is about $2 trillion worth of securities underwater. When these top banks are added, we get anything between $3 and $4 trillion in funds that the Federal Reserve has unwittingly promised to these financial institutions. Who pays for this bailout? Is the Fed ready to return to the printers to help these mostly poorly managed banks? What happens when the one-year duration ends in 2024? Will the economy be buoyant enough for these banks to pay their loans, or is the Fed just delaying the contagion? This and more are the focus of the clips, which we will now bring you from the podcast. But before we do, please take a little time to like this video, subscribe to the channel, and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
I think that it's important to understand the facility that the Fed created. So what the Fed did this weekend is essentially create a buyer of last resort again. Now, how did they do this? So all of these banks basically have assets that they bought for $1 and are now worth 95 cents. And that's what's creating this whole issue, or 80 cents or 85 cents. You pick the number, but they're not worth the $1 that they bought it. What the Fed basically said is, okay, give me that asset, give me that bond. I will value it at $1 and I will give you $1 as a loan and you will pay me interest. And the interest rate, I think, is what's called OIS, and they added 10 basis points on top. So I think it's about 4.9%. So what it allows all of these banks, and if you take all of the banks that are not the top 4 in America, so the top 4 are JP Morgan, B of A, Citi, and Wells. So just ignore those for 1 second. The other N banks, if you look at all of the assets that are underwater because of all the rate hikes that Sachs talked about, and you add up all those losses, that is about $2 trillion. And the Fed didn't announce that there was a beginning and an end to this program other than saying these would be one-year loans. And so I think the exposure for the American banking system at a minimum is going to be this $2 trillion, because now the incentive, if you're a banker right now running one of these banks that has not gone under, is to immediately go to the Fed, put all of those assets to them, get a loan, and now take that and buy different assets, different bonds, different US treasuries that are yielding much more than what your old treasuries were yielding. And I think that's the arbitrage that we've unfortunately created. And the other question now, though, however, is what does that mean for the top 4 banks, right? Because if it's $2 trillion for everybody else but the top 4, what's the gap for the top 4? That looks like it's somewhere between $1 trillion and $2 trillion. So that's another amount of money we're going to have to, or the Fed will have to backstop. And then, as Friedberg said, these checks always come due. What do we do in a year? Because in a year, the problem is the only way to make the banks in a position to repay this much money in 1 year is to cut interest rates so massively that these assets massively inflate, and now all of a sudden you're in a position to cover this. So
and
it's
describe
a very...
what that delta is, because it's about, they're down 15%, 10% in book value, these longer-term treasuries.
It depends on the security. Again, it depends on what they bought. We don't really know enough detail, so I don't want to guess. But if you own these 10-year treasuries, you could be off 10 or 15%. If you own mortgage-backed securities, it could be off a little bit more. If you own short-term securities, they're off a little bit less.
But these are with the government.
You get a loan collateralized by these assets. So you're still holding them, right?
Yes, and they mature.
So if the Fed takes an emergency posture and says, okay, guys, we want to avert a crisis in a year from now, and we're going to cut rates, these assets that these banks own will be worth more, which will allow them to repay the loan. As far as I can tell, all we've done is we've kicked the can down the road for a year. But I do think it's important for people to realize this doesn't solve the problem. It just means that mark your calendar for a year from now. We have a problem on March 15th, 2024, because all those folks that took money, what do? We need to have a real-time dashboard at every single Fed that allows them, for every bank that they supervise, to know in real time. They
Should
can
the public
choose to ignore it. I'm not sure that should be true, but they are their supervisors. They should see it. They should choose to ignore it, but they should not have it.
One of the all-in besties, venture investor David Sachs, clarified his stance on who should shoulder the blame for the collapse of Silicon Valley Bank and subsequent collapses. Sachs has been under fire all week for a series of tweets where he pins the blame completely on the Federal Reserve's interest rate hikes. In his tweets, Sachs denounced the media narrative blaming wealthy speculators or tech bros or venture capitalists like himself for the banking crisis, which according to him started in Washington. He added that the Federal Reserve's rate hikes, not VCs or tweets warning about the impending collapse, resulted in the demise of the state-chartered commercial bank. During the podcast, Sachs clarified his tweets and stated 6 categories of perpetrators he believes were in some way or the other responsible for the collapse and the subsequent contagion. Sachs and Chamath also discussed the role of VCs and wealthy speculators in the SVB collapse and actions that must be taken going forward. Here are more clips from the episode.
Number one,
Let's go through them.
Okay, number one, the bank management of all these different banks. Clearly, very poor risk management, didn't do a good job. They are to blame. However, and Chamath is right about these banks, they differ in the details, but the point is that they're all operating under conditions of extreme stress. Where did that come from? Number two, the Fed's rapid rate tightening cycle. Clearly, I think that the combination of poor risk management with the spike in interest rates, that basically has precipitated this larger problem. Number three is, I think, the Biden administration's spending, which in fairness started with COVID before Biden, but Biden really intensified it. And then I think it really compounded the problem in the summer of 2021 by claiming that inflation was transitory when it wasn't. That allowed them to keep spending and keep printing money and kept QE going for another 6 months. That created the bubble of 2021. Everything got super frothy. And then that made the rate hike cycle even more vicious because you started 6 months later. They could have started 6 months earlier and it could have been more gradual. And I think that really was a disaster for the economy. Okay, number four, the dereg in 2018. I think Elizabeth Warren and Ro Khanna have made what I would call a compelling case that the dereg in 2018 have contributed to this problem. I think in hindsight, creating a 2-tier system of banks where one tier are the systemically important banks who are completely guaranteed and backstopped by the federal government, and then a sort of lower tier, a second tier of regional banks was a poison chalice for the regional banking system because in the short term, it meant they were more lightly regulated, which may be appropriate for smaller banks that aren't these mega banks. However, it has also now, I think, created a situation where people are less confident about them. And so the money flows are going from the regional banks to the systemically important banks, the SIBs. So like I said, it might be a double-edged sword. And I think we're going to have to look at those regulations and figure out what's the right regulatory regime to create confidence in the regional banking system. We want a thriving regional banking system. And so the question is, what's the right regulations that get us there? And then the final two that we can talk about later are, I'm hearing wokeness getting blamed, which, listen, I think that wokeness was a distraction. There were a lot of crazy programs happening at these banks. But listen, if wokeness was the key factor, the whole Fortune 500 would be out of business because they all do this stuff. They all do this stuff. So I think we're going back to the well a little too often on that critique. And I don't want I don't want to burn that critique out because I think that wokeness is bad, but it's not the key reason why this stuff happened. What I would say for sure is that if these banks had spent as much time on risk management as they did on ESG or on woke, then this crisis wouldn't have happened. So definitely a distraction, but not the thing that like specifically caused it. And then just the final thing is VCs. And I just can't fathom at this point, given the multiple bank failures, given that we see the larger problem of unrealized losses on bank balance sheets, that somehow any class of depositors would be blamed for this. That just makes no sense to me.
Chamath?
I think the critique is specific to Silicon Valley Bank because I think, and this article was in the Wall Street Journal, but what it shows is a really complicated, intertwined relationship between VCs and Silicon Valley Bank, where VCs were given very cheap interest rate loans. They were given GP call lines of credit. They were given LP lines of credit. And then those same VCs would be directing their companies to put their deposits inside of SVB, who would then take those deposits and buy risk. Yeah. In some cases, Silicon Valley Bank is a limited partner in all of these funds. So imagine a situation. You go and start a fund. Silicon Valley Bank comes to you and says, let me be a limited partner and invest with you. Let me give you some amount of money. I don't know where that money comes from Silicon Valley Bank, but well, let's be realistic. More like 25, 50 million, 100 million. Okay, this is a lot of money. Okay. So $1 million kind of is whitewashing this problem. So you give them a reasonable amount of money. They're like, wow, I have tremendous loyalty for you. Thank you. Well, do you need anything else? Do you need personal loans? Do you need lines of credit for your business? Sure, why not? I take those too. And invariably on the back end now, your loyalty obviously builds up. Again, none of this is wrong, but this is what's happening. And then you tell your companies to keep your deposits there. Maybe the cash management program is not as strong as it would have been if you were more circumspect and you didn't have those incentives to direct people to one institution only. In any other part of the market, so in the public markets as an example, there is such a bar for disclosure. Okay, and I cannot stress this to you enough. Related party transactions, all of this stuff, we have to tell everything, not just for us, but even if our sister or brother or mother may have a transaction with an entity that we're doing a deal with. And it just isn't the case in private markets. And so it's not to say that anything untoward happened, but when people point the finger at VCs, I think they are pointing to this whole set of issues and asking the question, shouldn't there have been more disclosure and transparency around it? And now that this has come to pass, shouldn't we explore it? And I think that's what the Wall Street Journal did. They started pulling on this sweater thread. And my guess is that you're going to find a whole ball of yarn at the end of it.
Despite the Fed's intervention, this could blow up to be a much bigger situation than most people expect. According to a Thursday article from Watcher Guru, economists have found that almost 200 banks are currently in the same situation as SVB before the bank run and eventual collapse. According to the article, the economists evaluated asset books and market value losses of individual U.S. banks. They also examined their funding percentages to ascertain the percentage of uninsured depositors. They found that at least 186 banks could run into serious problems if even half of the uninsured depositors scrambled to withdraw their deposits. The economists concluded that the FDIC would have no choice but intervene over and over for each of these banks. What are your thoughts on Sachs and Chamath's detailed analysis of the situation? Do you think this is the beginning of widespread contagion in the banking sector in the U.S., which would no doubt spill into other countries? How many more collapses do you think will be announced in the coming days? Please drop your comments and observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.